So, chapter five, we will be covering provisions and options. So, some of the provisions, standard provisions you're going to come across in different types of life insurance policies, and three different types of options that we'll be diving into. So, a couple of the words to know in this chapter. First one is insurer. This word we've seen a few times already. We've talked about it a few times. But insurer with an R at the end is just another word for the company. Okay. Primerica is considered the insurer. Okay. Um, Next is the insured with a D at the end. And the insured is the person that's being covered with the life insurance, right? The client that is purchasing the life insurance policy on themselves. Lapse, we've covered this word already a couple of times, but this is when a company cancels a policy due to non-payment. So you may see it written as lapse or lapsed with a D at the end. Okay, a lapsed policy. And we'll cover a little bit more on that as we continue on this chapter. The word rescind and rescission. They mean the exact same thing. It just depends on how they word it in the question, but they're the exact same word, just written differently. They mean the same thing. Is when an insurer cancels a policy for violating a material fact, meaning the company has now the right to cancel the policy because there was information that was withheld. Okay. And as we continue on in this chapter, we'll go a little more in detail in that. Provisions, just what a provision is, it's just a benefit inside of a life insurance policy. So added benefits inside of a policy. And then a dividend is a return of excess premium. Another word for it that you may see on the test is earned surplus or unused premiums. So it is money that the company collected that they did not end up using. Okay, so that dividend will be returned to the policy owner. Now, couple of the standard provisions that we're going to go ahead and cover in this chapter. So first off is ownership. So ownership of a policy is basically the individual that is entitled to make any changes to that policy. So the ownership can make any changes. They can change the beneficiaries. They can change the premium mode, meaning from monthly to annually or annually to monthly. And they can also change any of the options in that policy. The owner of the policy owner, is the person that has ownership of it, and they're the ones that are entitled to be able to make any of these changes. Okay. Next is the term assignment. So assignment is to be able to transfer ownership of a policy to someone else. So just think you're assigning it to someone else, meaning you're giving up control of that policy to someone else. Now, there's two different types of assignments in insurance. The first is what is known as collateral assignment. So, collateral assignment is where you're going to give someone temporary control. Another word for it would be you're giving partial rights of that policy to a bank. So, for example, let's say I'm covered for $500,000 with life insurance, and I go to Bank of America and I want to I want to get a loan from them. And they say, okay, well, based on your credit history, right, your length of credit, we can't give you the loan. And then I mention, hey, I have a life insurance policy where I'm covered for 500,000. I know the loan that I'm working, looking to get from you, Bank of America, is 250,000. So what I can do is I can give you collateral assignment of my policy. So I can give up partial rights, meaning I put them as a beneficiary for 250,000 so that if I pass away, they get their money back. That would be a type of collateral assignment where I'm giving up partial rights of my policy. Now, the second type of assignment is absolute assignment. So, absolute assignment is where you're giving up all rights. of your policy to someone else. So here, for example, is let's say, husband says, "Hey, I don't want to pay for the life insurance anymore." And wife says, "Well, you need to have something. I'm going to take over it. So I'm going to become the policy owner now." So he gives up absolute assignment of his policy to his wife. His wife is now the owner of the policy, and she's the one that can make any of the changes because now she has full ownership of that policy. Okay, so that would be an example of absolute assignment, giving up all rights. So entire contract. So an entire contract in insurance is made up of two parts, which is one, the policy, and two, a copy of the application. So that is what makes up the entire contract. The policy and a copy of the application that is basically stapled to the back of the policy, which is considered the entire contract. Next is the grace period. So grace period is the period of time that a company gives you to make a late payment without your policy lapsing. Okay. So the grace period is a time that will prevent the policy from lapsing. The grace period is 30 days that you have to make a late payment before the policy lapses. So, for example, let's say my payment is due the first of every month. Let's say it's January 1st. I switched bank accounts. I forgot to let the company know. So they weren't able to draft me for my premium for the month. Now it's January 2nd. So I have 30 days from my due date, which is the 1st. So from January 1st, I have till February 1st to pay that premium, okay, without the policy lapsing, which remember, lapse means that the policy was terminated due to non-payment. So after that 30-day grace period, if the premium still is not paid, then the policy then lapses. Okay. And in a whole life policy, once the grace period ends, then the automatic premium loan will kick in, which means that they will automatically take a loan from your cash value to pay the premium. Once that, right, which is the savings account in a whole life policy, the cash value, once that gets taken down to zero, then that's now when the policy lapses. Okay. Now, next is the free look period. So the free look period, it says is once the policy is delivered, signed, and dated, that's when this provision begins. So once the policy is delivered and dated, you have, if you decide to not keep the policy, you will receive a full refund of the deposit that you gave. So if you are below 60 years old, so 60 and under, your free look period is 10 days, where you can go look for another policy. If you decide to cancel the one you just obtained, you can do so within those 10 days to receive a full refund. Now, you can cancel at any time. But in order for you to get a full refund of the deposit that you gave, it has to be done within those first 10 days. That's if you're below 60. If you're over 60, it's 30 days. So they're going to give you a little bit of a longer time, right, to cancel to receive a full refund. Now, within those 30 days, once those 30 days are up, then you can cancel it still, but you will not get a full refund. So on the test, there may be a question you see that asks, in this state, what is the minimum free look period? And that would be 10 days. Okay. And then 30 days is for anyone that's over 60. So on the test, you may see a question that says a senior consumer. Okay. Senior consumer, they're referring to anyone over 60. Now, next is the incontestability clause. So the incontestability clause is after a policy has been enforced for 2 years, the company cannot rescind the contract. Meaning, once a policy has been in effect for 2 years, then that company cannot rescind the contract, meaning they cannot cancel that contract based on, if someone was not truthful. Okay. So like with majority of the companies, there is a suicide clause that if anyone commits suicide within the first 2 years of having the policy, the company will not pay out. Once those 2 years are up, then the policy becomes what's called incontestable. And now, even if the person dies due to suicide after the 2 years, the company will pay out the death benefit. Okay. So within the first 2 years, that you cannot, which is known as the incontestability period. Next is the term reinstatement. So, reinstatement is when you're going to bring back a lapsed policy back on the books. So, for example, let's say, I left out of the country. I've been gone for 4 months and my policy's been lapsed for 3 months, completely forgot about it. So now I want to reinstate my policy. So I want to get it back on the books. Now I can do so, but I do have to pay any unpaid premiums. So I have to pay all back premiums. So meaning those 3 months that I owe, I have to pay those to get myself up to date. Now I also have to pay um, any outstanding loans. So if it's a whole life policy, if there's any outstanding loans, then I have to pay those as well. So, and I also must show proof of insurability. So what that means is that I have to do another blood and urine exam to show that I am still healthy, like when I first applied for the policy. Okay. Continuing on, we're going to go through misstatement of age or gender. So, misstatement of age or gender, it says death benefit will be adjusted if found lying of your age or gender. So, what that means is, for example, let's say I apply for life insurance and my actual age is 35 years old. But on the application, right? So I'll put application age. I say that I'm 30 years old, but I'm really 5 years older. So let's say 10 years go by and I pass away at age 40, quote unquote, right? On the application. But, they do my autopsy, they get all my paperwork, and they realize that my actual age of when I passed away was 45. So I was 5 years older than I had originally that I had then I was 5 years older than I had originally said. So the company's not going to deny the claim. Why? Because of the incontestability period. It's already been enforced for 2 years. But all they're going to do, as it states here, is that the death benefit will be adjusted. So let's say, for example, they calculate that I should have paid an extra $5,000 in premiums, right, over the course of those 10 years that I had the policy. So all they're going to do is they're going to deduct that 5,000. Let's say, my life insurance coverage is 150,000. So they deduct this 5,000 from here. So my beneficiaries are only going to receive $145,000. Okay. So it's just going to be adjusted to whatever the extra premium that should have been paid. They're just going to deduct it from the death benefit. Okay. But they still pay out the death benefit. Okay. Next are exclusions. So exclusions are most common reasons why a company will not pay a death claim. So basically, another word for exclusion is things that are excluded from a policy. Okay, excluded from being covered in a policy. So, an easy way to remember this is the acronym WASH. So, the W stands for war or military, right? A lot of companies will not pay out a death benefit if the person passes away in war or military service. The A is aviation, which a lot of companies will not cover pilots, stewardesses, for example. Why? Because their life is more at risk radiation, they're out on a plane daily. So they may exclude that. The S is suicide, and that's with every company within the first 2 years, it is excluded. And the H is hazardous hobbies or occupation. Hazardous hobbies or occupation. So let's say, for example, I work and my job is a skydiving instructor. That's pretty hazardous, right? Because I'm jumping out of a plane multiple times on a daily basis. That's a high risk. So some companies will exclude that from being covered. Okay. So exclusions, easy acronym is WASH, WASH. So continuing on here, we'll go through beneficiaries and beneficiary provisions. So beneficiaries are the individuals that are going to receive the money from the life insurance, right? The death benefit proceeds. So first is the primary beneficiary. So the primary beneficiary is the first person in line to receive the insurance proceeds. So, for example, husband has life insurance, wife he puts as a primary beneficiary, meaning once the husband passes away, the wife is the first person in line to receive the insurance proceeds, right? The money. Okay. Second is a contingent beneficiary. So, a contingent beneficiary is the person second in line to receive the death benefit. So, for example, husband puts wife as the primary beneficiary and then puts his son as the contingent beneficiary. So the contingent beneficiary is the second person in line. Now, the only way that the contingent beneficiary can receive the death benefit proceeds is the primary has to pass away before the insured. And then when the insured passes away, then those proceeds will be paid to the contingent beneficiary. So the only way that the contingent beneficiary can receive the money is that the primary has to predecease, and you may see it on the test. The primary predeceases the insured. Then the insured dies. Now it's paid out to the contingent, right? The second person in line. Okay. Next is the common disaster clause. So the common disaster clause, it says if the primary and the insured were to pass away in the same accident, right, a common disaster, the contingent beneficiary receives the money. So, for example, let's say, husband and wife are in a car accident and they pass away. Obviously, the insured passes away, the primary passes away. Therefore, now the money goes directly to the contingent beneficiary, right? The second person in line. Even if the insured passed away before the primary and then the primary passed away, because of the common disaster clause, the company's going to say, no, the primary passed away first, then the insured. That way, the money is paid out to the contingent beneficiary, okay, the second person in line. All right, next is the spendthrift clause. So the spendthrift clause, there's two parts to it. But what it does is it is meant to protect policy proceeds. So it's meant for the wishes of the insured to be granted in a sense. So for example, there's two parts to it. So spendthrift, right? So the first part is that it protects the insured's original wants. So, for example, if the husband chooses that he wants the death benefits proceeds to be paid out to the wife over the next 10 years, then that's what the company's going to do, right? The beneficiary can't go to the company and say, hey, actually, I know, my husband wanted this money to be paid out over the next 10 years, but I actually need all of it right now. Can you just give me a check for all of it right now? This spendthrift clause protects the beneficiary, or it protects the insured's original wishes so that that does not happen. And the second part of the spendthrift clause is that it makes sure that creditors cannot touch the proceeds of that death benefit. So, for example, let's say husband owed $100,000 to Bank of America. He passes away. Then Bank of America somehow gets wind that he had life insurance. This clause protects wife and kids from Bank of America knocking on their door saying, "Hey, your husband owed us $100,000 in debt, right? He owed us $100,000. We knew he had life insurance, so we need you to pay us our money from that life insurance policy." This spendthrift clause protects um, the family so that that does not happen. Okay, creditors cannot go knocking on your door. Now we're going to go through three different types of options. So the first is what is known as non-forfeiture options. So non-forfeiture options will be found in whole life insurance. Okay. And remember, whole life insurance is life insurance that's bundled with a savings. Okay. So when they're referring to non-forfeiture options, what they're referring to, if you look at the word non-forfeiture, there's the word forfeit in there, which forfeit means to automatically lose. So non-forfeit means you cannot lose. So what they're referring to as far as non-forfeiture options is they're saying that you cannot lose the money that you've already put into the savings, okay, into your cash value. So if you decide to cancel your whole life policy, right, or surrender it, then you have these three options of what you can do. Number one, most common is you can use the cash option, which means you're just going to get a check. Let's say you have a total of, $8,000 in your cash value, then you can take that $8,000 and get a check for 8 grand. Okay, they just think they cash you out. The second option is, let's say on this whole life policy, your original coverage was $50,000 of life insurance on this whole life policy. The extended term option, if you decided to go with the extended term option, is where you would basically not receive the cash. So you're not going to get a check for the $8,000. What you're going to do is you're going to take that $8,000 and purchase an extended term policy, which is going to give you the same amount of coverage. So it's going to give you the same $50,000 worth of life insurance coverage, but for a term policy. So let's say, that $8,000, it buys a term policy for 21 years. So that means that you're going to have a $50,000 term policy for 21 years that you do not have to pay for because they're going to use that $8,000 from the cash value to pay for it. Now, the third option and last option is the reduced paid up option. So the reduced paid up option is where you're going to take the same $8,000 and you're going to purchase a paid up policy. So it's another whole life policy that's paid up, meaning you don't have to continue paying for it monthly, but it's reduced. So what is reduced exactly is the coverage. So the coverage is not going to be $50,000 anymore. Now let's say it's going to give you $21,000 of whole life insurance coverage, but you don't have to keep paying for it because it's completely paid up. Okay. So those are the three non-forfeiture. So next type of options are dividend options. So dividends, remember, are unused premiums. So premiums that were overpaid, overpayments, or also known as earned surplus. Okay. So one thing also to remember about dividends is that dividends are never guaranteed. So they are never guaranteed and they are never taxed. Okay. So what are the dividend options? So number one is if the company at the end of the year determines that there's a dividend, meaning there was premiums that they did not need or used, they will refund it to you, right? That dividend will be given back to you. Now, here are five options of what you can do with that dividend. So, for example, let's say the company determines that it's $100 dividend at the end of the year that they're going to give you. The first option that you have is what is known as a 1 year term. So, what you can do with these $100 is not purchase, but add a 1 year term to your existing policy to where you can have more coverage for just 1 year. So let's say, for example, the policy is originally $200,000 of coverage. And you take that $100, you add a 1 year term to where for that year, you're going to have an extra $25,000 of coverage. So total 325. So if individual passes away within that 1 year, the beneficiaries are going to receive 225,000, right? It said 200 grand is the original policy. So 225,000. Once that 1 year term is up, then the policy goes back to the original $200,000 of coverage. Now, the second option is a cash option. So, cash option is just where the company's going to mail you a check for the $100 dividend. Okay, they're just cashing you out. The third option is where you can use a reduction of premium. So, what they're going to do is they're going to take those same $100 and apply them to next year's premium. So, it'll reduce your payments, your premium payment for the following year by $100 because they're going to add it on to that next year. Okay, so your monthly premiums will be $100 less over the course of that year. Fourth is what is known as accumulation at interest. So here's where you're just going to take those $100 and just let it sit there and accumulate, right? Gain interest. Okay, you're going to put it into that savings account. And then the fifth option is a paid up addition. So what you're going to do here is you're going to take this $100 and you're going to add more coverage that's already paid up, meaning your premium isn't going to go up because you're taking those $100 and you're completely purchasing or paying up that extra amount. So let's say, once again, your policy is $200,000 of coverage. That $100 purchases another, let's say, $6,000 of coverage. So now your total coverage is 206,000, okay, for the remainder of you having that policy. So those are the five different dividend options that you have. Now, finishing up with the options are settlement options. So settlement options are how you are going to receive the money, whether from an annuity or from life insurance. Okay. Most common in life insurance is obviously the cash option. Here's where the company's going to give you a check for the full lump sum. Okay, if I'm covered for 300,000 of coverage, my family, my beneficiary is going to receive a check for $300,000. Now, if it's from an annuity, same thing. They're going to receive a check for the full amount. Okay. The second option or settlement option is the life only option. So here is where that income that I've accumulated in my annuity, in my savings account, is going to pay me out for the rest of my life. Okay. Until I pass away, basically until I pass away. They're going to make sure that that money lasts until I pass away. Okay. So it's going to pay out for my life only. The third is the interest only option. So the interest only settlement option is where, for example, husband, let's say he's covered for $300,000 of coverage. He passes away, that $300,000 is not going to be paid out to the wife. They're going to keep it in an account where it's going to grow and accumulate interest. And the wife is just going to receive the interest that that $300,000 gains. Okay. Then once the wife passes away, then that $300,000 will be paid out to the beneficiary, right? Let's say the children. Okay. It'll be paid out then. But to the primary beneficiary, it's just going to pay out the interest that that money gains. Fourth is a fixed period or period certain. And here is where the death benefit, right, or the money from the annuity is going to be paid out over a fixed period of time. So this is where you say, okay, I have $300,000 of coverage. I want When I pass away, I want that to be paid out to my beneficiaries over the course of the next 20 years. So then the company's going to divide it into even payments of that 300,000 over the next 20 years. Okay. So fixed period is where you're selecting a specific amount of time. And then the fifth option is what is known as a fixed amount. So a fixed amount is where you're selecting a certain dollar amount. So here, for example, let's say the coverage once again is $300,000 of coverage. You say, hey, I want my beneficiaries to receive $25,000 a year. Then the company's going to make sure that that money, that $25,000 a year is paid out until eventually that account goes to zero, right? Once it's at zero, then that's when this payout ends. Okay. So those are the three different types of options. So non-forfeiture options, dividend options, and then the settlement options. Okay. So once again, continue to review, continue to go over these as many times as possible. So you just become super familiar with each term so that pass the test very first time.